Not getting home on time, traveling at irregular moments, and so on and so forth. This, ladies and gentlemen, is payback time. Right. Yeah. In order to spend time wisely, I'm actually not going to introduce all the panelists. You all have your conference brochures. You can see their bios on pages 15, 16, and 17. And if you turn to page 18, you'll see the bio for Paul Kavuma, who's actually also appearing on the FMCG panel. But if I just quickly run through them, starting at the far end, so you can place the photo, link the photo to the name. Jinal Shah is the managing director of Auto Express. So you have an investee company in whom a leading private equity fund, Galactus, has recently invested a large sum of money. Next to Jinal is Paul Kavuma, who has the unique privilege of having set up the first private equity fund actually run out of Nairobi, invested in Kenya, in Tanzania, in Ethiopia, in a range of sectors, including retail, financial services, agribusiness. Franny Lotier, again very unique, running a private equity fund headquartered out of Dar es Salaam in Tanzania. I think that's the first actually, located in Dar. And looking at a very interesting space and interesting sectors. She'll talk more about that later. Next to Franny is Asif Abdullah, who runs a very complex business in transport, logistics, and fuel. Okay? So Asif moves fuel across Kenya, Uganda, Tanzania, DRC, Southern Sudan, and Zambia. Okay? Up through trucks, 300 of them, and up the rail, right? This is his assets are on the street, and what he's moving is flammable. Okay, so you get a sense of the business he does. Amir Somani, who's with Helios Investment Partners, who are the largest dedicated fund focusing on just Africa. They've now raised over $3 billion in capital, invested across a range of sectors right across sub-Saharan Africa, including, I think, now in parts of North Africa. And Sylvain Denise, who is a transaction advisor, worked extensively in the Middle East and North America, and currently transacting in Eastern Africa on a couple of very interesting transactions. So the point is you have a mix. You have private equity funds, you have investee companies, and you have a transaction advisor, which is exactly what you need to get a deal done in our part of the world. There are roving mics. I'm going to ask you to ask questions in the middle of this, in the middle of the panel, right? So don't wait to the end. If you have something burning, don't interrupt me. But well, you can. But I mean, just wait until there's a pregnant pause, and then please shoot your hand up, and we'll find you. We'll find you in the audience. I want to start first with Asif and Jinal, actually, because they're running businesses in the region. If you could just, Jinal, starting with you first, give us a sense of, the sort of business you run and why it was that I think last year you decided to invite private equity into what was basically a family business.
Okay, thanks very much, Karim. I am going to pay back today. So I guess Karim is the one who introduced us to our private equity fund, so he's a matchmaker in some ways as well. My brother and I were running a family business as an auto parts distribution business, mainly in the tire sector. At the time, only in Kenya and Rwanda. We have a B2B business sector as well as B2C, which is retail, so 26 outlets currently running across Kenya, Rwanda, and Tanzania. In 2012, December, we were introduced to Actis, which is a private equity fund, fundraising done in the UK, but basically deploying capital in the emerging markets from Asia, Africa, and South America. They were interested they saw the growth in consumer business, especially in the auto parts business, as middle class Africa is growing. They approached us, and Karim introduced us, and my brother and I had one, I would say, previous experience with a different private equity firm in 2010 when we didn't do the deal. But we learned a lot about dealing with private equity at that point. And so in 2012, when we met in 2013, we started the deal process, Karim, essentially. And it started around March or April, and we've finished the transaction at the end of the year. And it seemed like a long time, primarily because initially we were not first 100% aligned with whether we would like to do the deal, because we had a difficult time the previous time. Anyway, to cut a long story short, the deal did happen, and Actis came on board. They bought a 36% stake in our business. But we spent a lot of time during the deal process planning a strategy together. We had McKinsey come in. They did a consultancy on what the strategy should be. They validated most of the stuff that we were already doing, but added a few more things. And then a normal due diligence process. And from January 2014, Actis has been participating.
General, could you just describe very briefly what your business does?
Yes.
Yeah.
Okay, so we are distributors for auto parts across Kenya, Rwanda, and Tanzania. But tires, for example, we're distributors for Pirelli, Dunlop, 9 or 10 tire brands, suspension parts, batteries, and so forth. Yeah.
Are there any questions? Dickie, right here in the middle. And then I'll get to you next. Great.
Thank you. Can you hear me?
A bit louder.
Can you hear me now?
Yeah.
Okay, the worry with equity is the word venture capitalist. Which one of you are venture capitalists? That's the first question. The second question is, what is the relationship between debt and equity? If we take in equity, I sold part of my business to a venture capitalist, a nice one, two good venture capitalists, in 2000 and 2001, and I had the right balance between equity and debt. Do you have a view on this, especially the young man from Mombasa, Helios, I know you, etc. Do you have a view on this? And the third thing that worried me was the earn-out period. The 6 years, the 5 years. I had this black cloud hanging over me for 5 or 6 years. I had to get out of it somehow or other. Luckily, I got ill and sold the business. but frankly, that's a big worry for any chief executive of a company like mine at the time. So 3 questions for you. Does venture mean equity? Because the word venture capitalist does frighten people. Frightened me at the time. Secondly, the 6-year period, the 5 or 6 year period, what happens if you can't make the numbers? And also, what do you expect as a return on capital?
Thank you, Dickie. Just before you answer that, to give you some context, the gentleman who just asked the question is Dickie Evans. He created Kenya's most successful floriculture and horticultural company. 8,000 employees at its peak, and he sold it at the peak in 2007 to James Finlay's. Okay? Had private equity, exited private equity, I think through that sale, Dickie?
Yes.
Through that sale. Emil, I'm going to have you respond to that question.
Yeah, sure. Thank you very much for the question. I mean, private equity tends to have a very negative connotation. And I mean, you have these visions of kind of these buyout kings in the West who over-lever businesses and put them into bankruptcy. The reality is that if you look across the Helios portfolio, the maximum amount of leverage that we'll have on an investment is about 2 to 3 times profitability. Whereas kind of if you look at North American and European buyouts, the level of leverage that they use is kind of 5 to 6 times. So we're using much more conservative leverage. And the reason is a couple of things. One, debt is more expensive. And secondly, performance is not as kind of stable as it is in the West. So kind of companies have lower leverage. The second is, I wouldn't call us kind of a venture capital or a private equity fund. What I would call us as kind of problem solvers. So when we meet with entrepreneurs and business owners, we try to figure out kind of what is the issue. If it's over leverage, we'll figure out a solution. If it's kind of growth in your business, we'll figure out a solution. And I mean, the last 2 deals that, firstly, we've never had an earn-out in a deal, so it's never worked with us. But the last 2 deals that I've looked at, we actually didn't structure it as an equity investment. What we structured it as is a debt investment. So there was a certain coupon that was required, and above that coupon, there was some sharing, but everybody shared in it. So I think you have to have a very flexible approach to capital. You have to be a problem solver, and you can't be like these buyout kings over-levering assets because it's just not going to work on the continent.
Right. Before I get to your question, sorry, I just want to pick up one other theme, and then I'll get to your question next. Emil, one of the things I've seen you do, and there are a couple of examples of this, and I just want you to speak to this. I'm assuming that there isn't, relatively speaking, a shortage of capital in the Gulf. Okay, that's probably a broad statement, but in general, there probably isn't a shortage of capital in the Gulf. There may, however, be capital that is less experienced in Western Africa than, say, capital from what I call the post-colonial world, okay, who are much more familiar with the continent, right? I know there are a number of transactions you as a fund have done. I have in mind the Vivo Shell deal, the BTG Pactual deal, and the Portugal Telecom deal, where I don't think any of those partners needed capital from you per se. Okay? Why did they decide to JV, if I can call it that, with Helios on investments where they probably didn't need your capital, but they took it anyway?
Yeah, I would say that there's probably two fundamental gaps on the continent. One is kind of a shortage of financial capital, and the second is a shortage of human capital. So there is a real lack of expertise. And one of the things we've done consciously as a firm is we've looked internationally to see if we can find that expertise and then figure out a way to bring it to the continent. So we've partnered with Shell, we've partnered with Vitol, BTG Pactual, Petrobras, Liberty Global, Altice, a number of international companies. And the reason why we like partnering with them is because they've done it in other markets. They bring world-class management, they bring world-class kind of intellectual property. What we bring to them is connectivity on the ground. So we have portfolio companies in 35 different countries. We have an office in Lagos. We have an office in Nairobi. We've worked with investee companies on the ground. We've developed and grown companies. So they view us as kind of the conduit to Africa. And given that we have that experience, we can then work with them to structure the marriage so that we can add a lot of value. And if you look at Shell, I mean, that's a business that has overperformed our initial expectations. It's one of the best performing assets in our portfolio. And it's a marriage that has gone really well. And it's a testament to the fact that when international investors and international institutions come into markets, paired with kind of individuals who understand those markets, you can make and generate a tremendous amount of value.
I just wanted to address the earn-out question when you mentioned 5 or 6 years. To me, and in the transaction I've been involved, the earn-out mechanism was designed to bridge a gap. It wasn't a blanket, you need to work and earn your way out of this for the next 5 or 6 years, you know, without a real logic to it. So this is something, in order for it to work, it has to address a gap whereby, for reasons that are reasonably predictable, the company is likely to do big move in the next year or 2 years or even possibly 3 years. And in order to bridge the gap between what the entrepreneur believes it's worth and what the buyer is willing to pay, and I look this way because I think you probably know that gap quite well, that's where you design that earn-out mechanism. It has to have a logic that relates to the gap that you're trying to bridge, not a blanket statement. I've never seen 5 or 6 years, by the way.
Great. Sorry, there's a question at the back first I need to take.
Hi,
Thanks.
this is Suleiman from TriCap Investments. It's an investment company based out of Dubai. My question is for all the private equity guys, and it touches on one of the most important aspects of the private equity cycle, which is the exits. And it's more important for Africa because private equity is relatively new in Africa compared to other places. How challenging is it for you guys to find an exit out of your investments? And what sort of exit planning do you do? Is it, how important it is at the time, the investment decision? And what is the mode of exit that is more common or that is more, is it IPO, trade sale, or sale back to the sponsors? Thank you.
Great. I'm going to just about a minute and a half each, starting with Paul and working this way. And preferably give some concrete examples or strategies.
Okay. Firstly, the fund I'm currently managing, we've only been investing for the last 4.5 years, so we haven't had any exits, but we would expect to start exiting by next year. Okay, and the predominant form of exit we would expect is trade sales, because we've got generally control deals or the right to sell control in the investments that we make, and we would generally have structured those things right at the beginning, the front end of our investments.
We haven't exited as a fund yet, but we, as an individual investor, I have, and so perhaps I can talk about both. On the fund level, in the discussion with the entrepreneurs before we close on the deal, we look at exit very seriously, and there are 3 opportunities that are quite unique to the markets. In the case of Tanzania, the country has just opened up on the local capital markets a window for small and medium enterprises where they can exit with less stringent requirements than you need for the traditional capital market exit. And the early results from that are very exciting because the degree of oversubscription for those local IPOs is very telling of the value that is hidden in there. So this is becoming a huge opportunity. Of course, the trade sales Paul has mentioned, but the third one is the owner buyback, where the owners, we have a situation where an owner, this is in a private investment, not with the fund yet because we haven't exited, where the owner actually says, I'd rather own 20% of a bigger company than own 100% of a smaller one. So they've seen the value of private equity. And I can say there, really, that's the demonstration effect. And that's maybe the best opportunity for Africa going forward, where we can demonstrate that people would be interested in owning having a bigger value for a smaller share of the company than a bigger share of the company at a smaller value. But those are the three that we, one I have personal experience on, and the other two are in our work as we prepare the investments.
Great. I mean, and sorry, Franny, if you could just address Guy's question while I have you. Do you have any, if you're able to say, do you have any Middle Eastern money within your fund?
We haven't in our fund yet, but we've been approached by 2 family offices who are interested. They've asked for our PPM, which we have submitted, so we are hoping there will be an interest. But Tanzania and East Africa in general has attracted Middle Eastern investment. Right as we speak, 2 days ago, the biggest port in Africa, the port of Bagamoyo, the money has come from Oman and from China. So Oman and the UAE countries have been investing. Most of the real estate in Dar es Salaam is from UAE investments, hotels, the hospitality industry, real estate, some businesses as well.
Great. Emil, could you also address both questions,
Sure.
Carlos and Guy's?
Sure. So on the return question, I think it depends on the opportunity. So at Helios, there's really 2 products. There's a private equity product and there's a credit product. On the credit side, the return thresholds are, I would say, 12 to 18%, and that's debt capital, and the return will be based on kind of how much debt capital there is already on the balance sheet. On the private equity side, we target kind of 25% IRRs, and what we will do is we'll work with the companies in order to build a case to get to 25%. So we'll often look at kind of management cases or cases developed by a company that have, say, 15% returns. And then together we'll build the value creation plan in order to get it to 25%.
Right. And on that, Paul, is that broadly consistent with your investment thesis? I mean, give or take?
The short answer is yes, but Carlo asked 2 different questions. The first question he asked was, what drives us?
Right.
And then he qualified it with what returns we need.
Right.
And the returns are the same. But what drives us, certainly from my perspective, is to build regional businesses, champions of scale, that should be able to compete in a global arena with the best-in-class management, governance, systems, etc.
Right.
That's what drives us. That's a slightly different question.
Right. Sorry, Asif, I want to wrap up this question, I'll let you in. Do you have Middle Eastern money, Paul, in your fund?
Excuse me?
Do you have any Middle Eastern money in your fund?
No, none.
Emil, do you know the answer?
Yeah, so we have 0. In fact, 75% of our investor base is US focused. The rest comes from Asia.
And is that mainly family offices?
0.
Right.
Yeah.
No, from North America.
No, it's institutional capital.
Institutional capital, right. Okay. Asif?
I think that why would you like a private equity investor? If you're successful, I think it's scale and pace. If you have a regional business, you can replicate that more in a shorter time span. And I think that I agree with you that buying back the equity is not success in anybody's terms because you're not aligned, because the private equity guy thinks that you're only buying it because you think it's cheap. And success should be that you open it up to more investors. So I think that's a very important success factor.
Great. Well, look, we could spend a lot more time here, and I'm afraid we can't. It's lunchtime now, and we're already a little bit behind schedule. So if you would please just join me in thanking our panelists. I think it's been really interesting. Thank you. I'm sure you'll meet them at lunch, but equally, I'm sure they're more than happy to hang around here for a couple of minutes if any of you have any questions for them. So thanks very much.